Hey, good morning, everyone. Welcome to the Macro Snapshot and to the new week. We are Monday, March the 9th, 2026. Obviously, the situation in Iran and the cost of energy is on everyone's mind. First of all, let's just have a quick look at the volatility situation. You can see that the VIX, it's come down somewhat, but basically overnight we got it to about sort of 35, so very, very elevated. Obviously, that's a headwind for equities and most assets. If we also look in the bond volatility, the MOVE index, that's also pushing upwards. No surprises that oil volatility is at extremely elevated levels. And of course, even like the precious metals, gold, is elevated, but not as bad as the others. So, volatility obviously very, very high. Margins are going up temporarily. There's been margin calls. So the point is that that's something to keep an eye on. In terms of what happened overnight, we saw that the oil opened up very, very high and spiked high. So we're now getting into levels of WTI, which were considered unmanageable sort of a week ago or so. But if you just compare to this is when the original sort of military action happened. So this is the weekend of, let's call it the end of February down here. We're at $70. So here we are spiking to over $120. So why has this come down? Basically, this is, I don't think the market is looking at this anymore as a sort of a win or lose situation for Iran and the US. It seems to me that Iran they elected the I think it was the eldest son of Khomeini who was who had been killed, and so that definitely sort of regime is not changing. In fact, it's a clear sort of symbolic signal of continuity. If you elect the assassinated leader's son, it's saying to the Americans, hey, this regime is not going anywhere fast. So I think that the chances for a quick capitulation by the Iranian regime are low at this point. It doesn't seem as though the US wants to have sort of ground troops there, although there's some talk about special forces going in maybe to try and grab some of the enriched uranium, but that's a very high risk kind of mission. Now, in terms of, will the regime topple? I mean, one can argue that for sure it's a sort of military infrastructure, its communications infrastructure, its economic infrastructure has been heavily, heavily, heavily damaged and compromised. But at this point, as far as I can see, we're not seeing any signs of the sort of uprisings in the street. Now, that could happen. And that, of course, would be one scenario where we could see sort of the end of the regime. Trump could declare regime change and victory, and then, everything would sort of calm down. But as far as I can see, we're not there yet. So I think from the Iranian side, my best reading is that we're going to have a sort of a grinding continuation, which means continuing attacks on certain amounts of sort of energy infrastructure in a limited way in the sort of the local area in the Gulf, continuing attacks on sort of non-Iranian shipping and the threat of more attacks in the Strait of Hormuz. From the US point of view, I think what we really need to look out here for is really the communication from the White House. And they're going to start sort of saying things like, mission almost accomplished, we've degraded their facilities, we've achieved our goals. I think really what the US needs to do at this point, I can't see them literally sort of doing ground troops and going in there and sort of, completely doing a regime change. I think really what the US will be looking for at this point could be, I mean, obviously, if there's a sort of an uprising, that's one thing, but absent that, I think really what we need to be looking out for is the communication that we've achieved our objectives. Their ballistic missile capabilities has been completely nullified. The uranium enrichment facilities has been destroyed, et cetera, et cetera. So I think what I'm going to be looking out for in the next 2 or 3 days, and it may be a question of weeks, is at what point can Trump and his administration sort of plausibly claim victory, which would be a sort of an excuse for an off-ramp to kind of pull things back. But again, I don't think that's going to happen anytime the next sort of day or two. And Trump over the weekend was came out with more sort of aggressive rhetoric, and on the Iranian side there was quite a lot of defiant rhetoric. So I think at this point the two countries will continue what's going on. Now, what is going on is some limited attacks on energy infrastructure, which is very much upsetting the market and caused some of this oil spike. And it's still just looking at the numbers, it seems that there's still very, very, very limited, 5 or 10% of normal kind of sea traffic going through the Strait of Hormuz. So, of course, that's putting upward pressure on energy prices, LNG, crude oil, but also, the processing like jet fuel oil is up 75%, diesel is up a lot, and also fertilizers. So a lot of fertilizer comes from this sort of area. sort of from Iran, and therefore that's putting potentially upward movement on food prices. Things like corn, which is a heavy user of that, is going up. If you look at the ZC sort of contracts, corn and whatnot is going up. So inflationary pressures. Now, the inflationary pressures. Well, let's just look at, first of all, just what's happening in the specific oil market. So we see here that oil gapped up. When I say oil, WTI, obviously it's the same if you look over at Brent, a similar kind of situation here, even a bit more of a sell-off here. But basically, oil, I mean, pretty crazy, gapping up overnight. The open was, sort of $7 or $8, and it went all the way up, I don't know, another $20 or $30. So pretty crazy, up to 120. But subsequently, the market has come down a little bit, and this is a key thing. We can see if we put this on a 3-minute chart that there were sort of news reports that the G7 will come together. You can see here around about sort of 1 a.m. sort of North American time. By the way, there's only a 4-hour time difference between London and New York at this point because of daylight savings. But you see a huge sell-off here. So about $116. We got all the way to 96. I mean, this is just extraordinary levels of volatility. But anyway, $20, 2,000 ticks sell-off here. And that was on the sense that the G7 might have a strategic petroleum reserve release. So the G7 countries might do a coordinated sort of flooding of the market by releasing some of their strategic petroleum reserves. We're also seeing that, keep in mind that Japan has the world's third largest strategic petroleum reserve as well. So who knows, maybe Japan and, some big European countries, maybe something from the US. Now there's a meeting, so that the rumors that was enough to bring down the barrel of oil $20. That meeting is apparently happening. The G7 ministers meeting apparently is happening at 12:30 US time, if I'm not mistaken. Did I get that right? I have to check on that. Was it, or maybe it's actually 8:30 and 12:30 in London. I have to double check that. That's very important. I'll check that after the video. But keep an eye on that. So the G7 ministers, now they're expected, some of the numbers that they're talking about the 300 to 400 million barrels of oil possibly being released, 300 to 400 million barrels of oil. Keep in mind that that would represent about 25 to 30% of the IEA sort of reserve. So a significant release. Now, and for context, keep in mind that in sort of March and April of 2022, after the Russians invaded Ukraine, a similar, excuse me, still a bit sick, kind of release was about 180 million. So we're talking almost maybe twice the amount of oil being released as occurred during the sort of the Russian invasion of Ukraine in March, April 2022. So keep in mind, I think what the market's expecting here or hoping for, as I say, between 350, 400 million barrels. Anything substantially less, I think, would be a disappointment. Let's say they come out and say, oh, we're doing 100 million barrels. But on the other hand, anything greater than that, 500 million, 600 million barrels would be a sort of welcome relief for the oil prices. And of course, if they don't agree on anything, that would be very, very negative, or, obviously would cause the oil prices to go up. So I think that's the key information for today, is that strategic petroleum release of the joint one from the G7. So let's keep an eye out for any headlines there. In terms of other stuff, obviously what's happening, I'm going to grab some tea, is a concern about global growth being hit. Of course, we're seeing, let's just go back onto the daily chart here for oil. But what is very, very interesting, if we look at some of the spreads here, so let's look at the sort of April to December 26 spread, getting up to crazy, crazy levels here. We at a certain point last night, overnight, we had a premium of over $40 per barrel. But what I want to point out here is that, is the market expecting this to go on for a long time? So if we look at the front contract here, which is April, as you can see, currently trading at $102. But let's just have a look here and look at December of 2026. And you can see here, this trading at $71, which is essentially where we were, a week or two ago. It's up a few dollars. What I'm trying to make here is that the market is really pricing in a relatively short problem. Now, of course, that is a problem, but the market is not expecting this war to go on for sort of 4 months or 5 months or 6 months. So keep an eye on that December, just as a benchmark, that December 26 contract. And you can see that, has it spiked up? Yes. But look at this, it's gone up $4 or $5 compared to something like the April contract, which has literally gone up 40 or whatever it is, 20, 30, $40. So the point here is that the market is still expecting a resolution. So then the question becomes, well, what kind of resolution? So I think there's kind of three scenarios. It's like maybe let's call it a speedy resolution, which maybe is like, the conflict dragging on for another 2 or 3 weeks, but there's some kind of off ramp. The US declares victory. Trump says, hey, I destroyed all of Iran's infrastructure. Iran says, no, that's not true. But, both sides agree that it's too damaging. What would happen there? It would have kind of a spike and reversal situation where, we've had the spike and then it kind of reverses down to somewhere maybe not going back to pre-war levels, but let's say at the front end of the sort of April-May contracts, maybe not down in the 60s, but maybe trading around about high 70s or 80s, something like that. Now, if that's the case, some of the trades could be, volatility would come down. We saw that VIX was super, super high. So you could maybe sort of sell the VXXX, sell VIX calls, maybe even sort of long put spreads. SVXY, something like that. So maybe sort of selling volatility. Also, it could be a question of buying Europe. If we look at Europe, you can see that, the equities over in Europe. Let's have a quick look here. Something like FXXP, so the Euro Stock 600 being absolutely battered. You could also see in Germany, you can see the DAX here being absolutely destroyed. So something like European cyclicals, if you're able to do that, European sort of stocks or just the general index, Europe would have a strong rebound. And then, of course, something like XLE, just the general energy space, which has been doing very, very well. And let's just take like a general ETF, XLE, which has been, had a huge, huge run up. I mean, I think, some long put spreads could be kind of interesting. So again, that would be on the news of sort of, a spike and reversal that, after a week or two, this thing calms down. All of those trades could be reversed. Of course, something you could be sort of selling US dollar onto that. You could be long into the Asian currencies, the Asian sort of stocks on the emerging markets, Australian dollar, and also long US equity. So a lot of trades there. What happens if it extends though? It just grinds on. And Trump over the weekend said, "Hey, a higher oil for a few weeks is not a big problem to pay, a big price to pay for sort of for future peace and prosperity." So Trump, I don't know. It's interesting to me that this is someone who's historically been extraordinarily sensitive to oil prices, and the fact that now he seems to be relatively sanguine and is saying, "Hey, we can put up with a bit of pain," and he's sort of adopting the tone of a statesman that short-term pain for long-term global peace. That doesn't really sound like Trump to me. So I just wonder here, is there some sort of evil plan he has or strategic plan? Somehow he really is trying to control Venezuelan oil, the flow of oil from Iran. He's trying to sort of choke off eventually sort of China, which obviously depends on most of its oil on Iran and Venezuela. Is this some part of a global sort of, sort of plan to sort of put pressure on China's energy supplies? I don't know, but it's unusual rhetoric here. But let's say getting back to that second scenario of an extended war, which goes on for not a week or two, but let's say 6 weeks, 8 weeks, something like that. At that point, that's going to be very, very negative for Asian stocks. Let's say something like shorting the Kospi or the Nikkei. You can see here just the kind of pressure, because these are huge oil importers, energy importers, and you can see here the Kospi, despite the incredible performance because of the semiconductors and the memory chips and whatnot, has been under pressure, because at the end of the day, Korea is almost a total energy importer. And then if we also look at something like the Nikkei here, you can see the Nikkei also under a sort of a lot of pressure here. So if the war were to extend, the Strait of Hormuz remains, essentially blockaded or blocked, that's going to be very negative for sort of, let's say, Asian equity. So something I would expect to see continuing sell-off there. You also have to start thinking about sort of high yield sort of bonds at this point, because credit is starting to come under pressure as the global economy maybe starts to sort of buckle a little bit. And just interesting to look at credit risk. If you actually look at the high grade credit here, so this is the LQDH, which does not take into consideration the yield. It basically strips out the yield and only looks at the risk factor. So for me, that's much better than LQD or HYG. But if we look at the investment grade one here, you can see that this is sold off quite a bit. But then if we look at high yield, that's also sold off and looks a pre-market to be even more aggressively sort of selling off. So high yield is starting to show a little bit of a few cracks. But it's interesting if we then look at the ratio of you. So you've got high yield here divided by investment grade. What is interesting is that that's been relatively sort of stable, but we are starting to see a few cracks here. So keep an eye on credit. And I think that if the war were to extend, some of these sort of higher yields, sort of junky bonds, the credit risk could start to go up. And we could see a bit of pressure there. So that could be an interesting trade. And then I think if the war were to extend, you could also think about the US dollar, which has been sort of very, very strong, especially against some of these emerging market currencies. I think that would continue. And if you look at, let's say, something like the US dollar, you see the South African rand. US dollar really starting to do well. If the war continues against some of these emerging market currencies like that, and the Brazilian real, Korean won, and whatnot, that would be something. Now, what about the third scenario, which I think is relatively low probability? Is like just a ramp up in energy infrastructure. So, Iran starts to damage, to destroy, to significantly damage, sort of oil production facilities in, let's say, Saudi Arabia, more damage in the Emirates and maybe even in Iraq and things like that. I mean, for sure, at that point, you'd probably that we're getting into a serious crisis there. You definitely want to continue to be long US dollar. You may even at that point want to be buying some sort of longer dated US bonds. I think gold would have a sort of a recovery at that point. Equities obviously be a heavy short, probably long the energy complex, XLE, something like that. So I think what we need to really think about here is the sort of duration. This is no longer really a question of winning or losing. It's a question of how long will the oil be squeezed, and the longer it's squeezed, it's almost like a sort of a theta decay. It's almost like a time issue. It's a function of time at this point. Is that's going to provide all the pressure. So we all know what's going on. I'm not going to belabor the point. We saw that equities had a nasty sell-off overnight, but they have found stability, and you can start to see some of the key points here. So obviously, we gapped down to the 200-day EMA, and we sold off further, but it has stabilized at that key level here, 65, let's call it 6,600 on the S&P futures. That's obviously the key level here to be watching. And you can see in a certain sense the 200-day moving average. If we go and have a look at NASDAQ, again, you can see it gap down lower, again, just below the 200-day EMA and just down below that level. So I would say that level on the NASDAQ here, about 24,000 is 24,000, 24,100. These are the key levels. Russell underperforming, I have to say, a 200-day moving average here seems to be the key one. But I would use as the benchmark probably the ES, because there's a very clean sort of line in the sand there. So somewhere between the 200-day. But as you can see here, it didn't push above that. We want to see evidence that the oil is starting to flow, de-escalation, at least maybe not militarily, but in the rhetoric coming, especially from the White House, would be useful at this point. The other thing as well to keep in mind is just what's happening with the real economy. If we just people forget, well, I don't say people are forgetting, but let's just go back and turn our attention. We did have a very weak non-farm payroll, so we had a stagflationary situation coming out on Friday. You can see the non-farm payrolls came in at minus 92,000, which of course was less than expectations and was very weak. We have U.S. private payrolls here. Minus 86,000 estimate was for plus 65. So very weak sort of headline numbers here. The revisions were down. You see the revisions were revised quite significantly downwards. If you look at the overall sort of trend, the 3-month moving average, whichever way you cut the cookie, that is sort of going very much downwards. And then the unemployment rate ticked up to 4.4. So we have non-farm payrolls, headline jobs coming down, the unemployment rate ticking up to 4.4. And then the other thing as well, participation rate going down. And the other thing to keep in mind is the average hourly earnings actually ticked up a little bit as well. So that actually went up, I think it was 0.4 on a monthly basis. So the point being here is that we have a stagflationary reading from that of a weakening labor market and sort of obviously energy, food prices, labor input prices going up. And remember, all of that is before we have all this whole energy thing. So base case scenario will be for the CPIs and the core PCEs to be going up. And this is not good news for the Fed. So, of course, the bond market, very, very unhappy about all of this. That's pretty obvious. I don't need to say anything. If we look at let's see, a ZF. So the 5 year, you can see that's it's fallen a lot. Is that stabilizing a little bit? We can see the 10 year ZN also sort of selling off over the weekend, stabilizing, but still very, very weak. You can see the ZB. The 30 year also the same thing. So at this point, we've got, the yields ripping a lot higher. If we look at, let's just look at those yields, which is US yields. Let's look at the 2 year. You can see that that's gone up 20, 30 basis points. If we go out to the 10 year, again, 20, 30, 40 basis points. The 10 year now at, almost 4.2, 4.17. It's come down a little bit in the last few hours. And the 30 year here about 4.75. So the point is here, very, very high interest rates. This is putting downward pressure on the equities. If the employment rate starts to sort of go up, unemployment rate starts to go up here, we're talking recession. Now, are we there yet? We're not. But if this continues for many, many weeks, this will put more and more downward pressure. So that's the whole situation there. As I say, first thing to be looking out for is just what happens with the Strategic Petroleum Reserve, and I would recommend keeping an ear out for the rhetoric. Also, the US dollar here just stabilizing a little bit, but basically it's been pretty strong. If you look at some of the key crosses, we're at very key levels here, sort of on the euro. You can see here just this pretty important level here at about 115. The market wants to hear good news. What would good news be? Energy prices coming down, nat gas prices coming down in Europe, maybe sort of some kind of sort of softening of the rhetoric from Trump, and then we could see a pretty nice significant bounce in the euro, and obviously general US weakness. If we look at the even the Swiss franc down a little bit, keep in mind that Switzerland is an importer of energy. So although it's a safe haven, it's also an importer of energy like Europe. So that's been under a little bit of pressure, not as much as the other currencies, but it's been under a little bit of pressure with the US dollar. And then obviously the Japanese yen has also been under pressure because of these higher yields, but of course it's almost like 100% energy importer. But we are getting to levels where either, maybe the Bank of Japan or the Ministry of Finance wants to intervene at about 159, and just technical overhead resistance here. So again, this is all going to be dependent on the duration of this military situation. There's no reason why this can't push higher, even if the Bank of Japan is unhappy about that. The one interesting currency has been CAD, Canadian dollar. Is doing very, very well here. You see USD is going down against CAD. It's almost like the only currency which has essentially been doing that. So CAD's strength here. And that's because obviously on energy, Canada is a major producer of energy and exporter of energy. So that's positive for the terms of trade. But also the Canadian dollar has high beta to the US dollar. So when the US dollar in general is strong, the Canadian dollar is it tends to outperform. So it's almost as though if the US dollar is strong, that's relatively good for the Canadian dollar, and if energy is spiking high, that's also quite good. So it's a fairly positive situation here for the Canadian dollar. And especially on some of the cross pairs, you see that the Canadian dollar has been doing pretty well. If you look at something like, I don't know if I have it here, but let's say CAD JPY. Do I have that? Anyway, CAD JPY, for example, is doing pretty well. So that's a currency to be looking at. And of course, if the whole situation reverses, the Canadian dollar will then be under a little bit of pressure. Okay, guys, I'm going to leave it there. So as I say, I think the key things is like the rhetoric coming out of the White House, any signs of a de-escalation, declaring victory, the time frame saying, just 1 or 2 weeks, we're getting very close. On the other hand, if Trump and what's his name, Hegseth, the Secretary of War, sort of continue to say this could be going on for months and months, and maybe special forces going in and whatnot, any signs of that increased rhetoric is not going to be great. We need to be looking at the bond yields, which is putting downward pressure on the equities. And the other thing as well is that on Friday we did have talk about Oracle and OpenAI and data centers, and maybe less sort of investment and whatnot. The market didn't like that at all, and the Nasdaq sold off I think it was like 1,000 ticks on that headline over on Friday. So definitely that AI story, let's not forget about that. That's super important as well. And any sign that these higher yields, increased risk to credit, could be putting sort of the financing of some of these data center builds under pressure. That will not be appreciated at all by the market, and that will put extra extra pressure on the Nasdaq, for example. And of course, let's keep an eye out for Europe today for the ministers. I want to check the meeting whether it's 8:30 North American time, or I know it's 12:30. I don't know if that's local time in Europe or here. So let's just check that, because if the Strategic Petroleum Reserve, if they release, 400 or 500 million barrels, that will symbolically probably put a bit of downward pressure on the oil price, which should bring down the bonds in terms of the yields, put up the prices of the bonds, turn down the yields, and that'll be a positive for equities and a negative for the US dollar, and could be a positive for other issues as well, other instruments as well. Okay, guys, I've blabbed on enough. I'll leave it there for today, for this morning. I'll be back tomorrow, and good luck trading out there, and keep your size small because the volatility is fairly elevated at the moment. Thanks very much. Have a great day.